All right, folks, welcome back. 3 at 3. This is where we let you know what's on the unusual activity, and today was very unusual. Why? Well, because I was on the halftime report, and I'll show you what was going on in just 1 second. Let's see here. There we go, 3 at 3. Um, Legal disclaimer, this is for educational and informational purposes only. You need to understand that. Now let's dive in. All right. So as many of you know, the halftime report starts at noon Eastern time. And take a look at what happened just before the top of the hour, noon Eastern time. Somebody stepped in and bought a bunch of puts. Now, a put option is the right to sell, like that, right? Well, with Gilead trading at roughly 83 bucks, somebody stepped in and bought the July 87.50 puts. That's an in-the-money put, folks. So that's going to move an awful lot just like the stock. Stock moves down big, these will profit. Stock moves up, you'll lose. You get the idea. It's a directional trade. It's not an out-of-the-money option. It's an in-the-money option by approximately $4.50. So they paid a lot of money for these because they're in the money by $4.50. Anyway, it's kind of interesting what happens after that, isn't it? Because as you heard us talk about on the halftime report, we had news leak from the Financial Times, and it was allegedly about a Gilead study for remdesivir, and that was leaked. And my friend Adam Fierstein was one of the people who got to see that on the WHO, the World Health Organization website. Was not for publication yet. However, if somebody saw that and reacted to it, they probably had a good 20 to 30 minutes lead on this news, and that should have been enough to make a lot of money. How much? Take a look. So there it is, just before, like I say, just before noon Central Time, this news was, or those puts were bought, and the stock was still over $82.50 a share. It was more or less $82.75 to 83. And look at that big steep drop. I'm sure you're shocked. In fact, it was so big that they halted trading for this particular stock. They halted Gilead down around $76 a share. Reopened, popped back above 80, and then sold right back down to beneath 75, which would have put these options in the money at the 75 level. The right to sell it at 87.50 would be worth at least $12.50 plus the time premium. You get the idea. This turned into a real crap show real fast. But the reason we're highlighting it for you is our subscribers saw this a long time before this went public on the halftime report and elsewhere. And somebody, maybe several somebodies, stepped up and bought a lot of puts and made a lot of money. All right, second trade for our 3 at 3. Bank America, BAC. Why? Well, because with the stock at roughly 22 bucks a share, that's 22, with it roughly at 22, they step up and buy December 24 calls. So those are out of the money. They're not going to move in the money amount like the previous example. These are out of the money calls at the 24 strike. And they paid about $2.50 for these. Now, $2.50 means $250 a piece. They bought nearly 9,000 of these, so it's approximately $1.8 million in premium, like that. That's why we want to follow those kind of people, because people that are putting down 7-figure trades are the people that generally, I think, have better information than you and me, and so I want to follow them. Let's see where Bank of America is now. It's just over 22. It was just under when we wrote that a little bit ago. Now it's just over 22 bucks a share. Again, they're buying the 24 strike And they're buying it out there in December, which means about 9 months into the future, because April, May, June, July, August, September, October, November, December, 9 months. You get the idea. So the embedded bits of information, 24 strike, out there all the way till December. It's a long-term bullish play. All right, next and last for our 3 at 3, and I apologize, I was doing an interview for a broadcast friend of mine, and for that reason was a little late with the 3 at 3 today. But nonetheless, I'm giving you 3 at 3, even if it did get started at about 3:05, 3:06. All right, let's look at this one. Delta. So this stock is just shy of 23. It was trading 22.57, so let's call it 22.50. They bought 19,000 calls. Now, a 19,000 call purchase, folks, is 1.9 million share equivalent, since every option is for 100 shares. So the fact that they paid 70 cents for 1.9 million share equivalent means they put 7 figures down for this trade, and about $1.3 million, let's call it more or less, for this trade. I like that. I want to follow somebody who puts 7 figures into a trade, so I did. And Delta, with the stock at 22.57 when we saw it, is right now 22.55, virtually the same spot as it was before, up about 0.3%. And as you saw, they were buying the May 26 calls, which were approximately $3.50, almost $4 out of the money by the end of May, the third Friday in May. So the embedded bits of information there are $70 per option, and they bought 19,000 of them. Smart money trade. I followed. Let's follow up on this tomorrow, shall we? There's Delta. Thank you for joining me today, folks. I hope you have a great day wherever you are. Remember, there's always a way to quantify risk. You can do it with options if you understand how they work. And we will be bringing Jeff Mackey, by the way, back Monday next week, joining us for the Volatility Roundtable. I hope you join us too. You can sign up. It's free. Jeff Mackey will be there. It's going to be fabulous. I hope you have a great